Welcome back to Balance Your Wealth. 2025 was a strong year in the markets, but strong returns don't always translate to peace of mind. Today, we're breaking down which asset classes actually led the way last year and how to use that information to rebalance, manage risk, and make smarter decisions heading into 2026. This week, I'm joined by Sean, Nora, Tyler, Nick, and Adam. Sean, want to go ahead and get us kicked off with the domestic versus international returns in 2025?
Yeah, so I think 2025 was a great story for really what's happened over the history of kind of the last couple of decades. So 2025 was the year of international, right? We got a new president who came in with some volatile, I would say, international policies, and certainly we saw that in the market. So with some of that volatility, we saw people pull out of treasuries, the dollar lose value, and international did really well because of that. And so the question is always how much international, if any, should I have in my portfolio? And does it make sense to use it as a diversifier? Certainly in 2025, international provided its value. However, if you look in the past, it doesn't always outperform the US. Historically, it's underperformed. So the question would be moving forward, does it make sense to have international and how much should I have in my portfolio?
That's the great question, right? And even the lines, like taking a step back, like even the lines of defining what is international versus US have been so blurred over the last 10 years because the biggest US companies are all multinational corporations, right? Like, Apple, Tesla, Microsoft, they get huge percentages of their revenues and sales from overseas. So there's kind of a like nitpicky sort of difference of getting revenues. So, yeah, half your revenue from China is a little different than buying Chinese stocks, right? And so, making sure that I would say being selective in international can certainly still make sense. Like obviously, 25 was a great year. It was the banner year for diversification, right? Like that was a good one. Most ships rose in 25, so we were all happy with that. But going looking forward, I agree, the US dollar going down by 7-10% in 25, but it was up just as much in 24. So it's kind of been this roller coaster for currency movements. But not to get too nerdy with you guys, the interest rates and the Fed, I think, are still the biggest, most influential factor in the global economy. And the fact that US had some of the highest interest rates on the planet last year attracted maybe more dollars than it was deserved into the really high yielding treasury assets. And now that rates are coming down and with the Papa Powell's replacement coming into office in mid 26, there's a good chance that rates come down even further, more aggressively. And so that just makes US treasuries look less attractive investment wise compared to other things. So I wouldn't expect there to be a big reversal in treasury demand or US dollar demand simply from an interest rate perspective in a vacuum. So I'd say dollar would be like flat, if maybe slightly down again in 26.
Yeah, I want to touch on a point that you and Sean both mentioned that 2025 was like a banner year for diversification. If you look at gold and silver, same thing, right? Like gold and silver have had lost decades where they've never outperformed the S&P, and all of a sudden, boom, they have 100% returns. And I think a cautionary uh, tale here is with international and with like precious metals like gold and silver is recency bias can come into play, right? I think all of us have gotten those calls like, hey, how much gold do I own? Should we buy more gold? Should I be more international? And you don't want to be someone who, after this past year, is now, 60% international and 40% gold and silver, right? That's not going to be a a portfolio for success. So this is why we diversify. Some asset classes outperform others every year, and 2025 is a perfect example. But just don't get caught up in recent performance numbers.
Yeah.
Stick to that diversified, well-created portfolio that Nick puts together.
Sell those winners, baby. Like when you see gold or international outperform, that's your opportunity to take those winnings off the table and redeploy to things that maybe haven't done quite as good, right? So that's more the approach, like the opposite of the 60% international, 40% gold and silver for 25. I'd say maybe do the inverse of that. Like take those winnings, put them in other places, and keep rolling.
And it's really challenging when, you go to the golf course, you go to the gym, and your friend's like, I'm in all gold and I'm killing it, right? To not do that, just as Tyler said, like you're chasing, right, the old returns. And certainly we all wish we had 60% gold, 40% international last year. But if anyone did, right, then they've underperformed for a really long time. And so when you look at a portfolio throughout a year, you want to see different asset classes performing at different times. And gold specifically has got about the same amount of return as the S&P over the long term, but it comes with so much more risk, so much more volatility. So does it make sense to be in the portfolio? I'd argue, right, very little, right? There's very little argument to say, I want more risk for the same return.
Yeah, Nick, to your point about taking some off the table, what are some asset classes that didn't perform as well that you think may be good to rotate into?
The first thing that comes to my mind is we look at like the small cap space is yeah, the Russell 2000. Over half the companies have historically had negative profit. Like they're unprofitable. And as we find ourselves in this cultural moment of the AI revolution, it's like if there was ever a chance for a small company to become profitable, it's probably going to be because they found ways to leverage AI and actually tip them from negative earnings to positive earnings. So I'd say all of those companies that have historically lagged on efficiency, fragmentation, being unprofitable, I'd say like there's huge opportunity for great turnaround stories. And I wouldn't say like across the board all the time, but I think small caps could do really well in 26. And then obviously just whichever sectors, if you look at it from sector lens, have gotten beaten up the most. Almost always, though, it's common. The worst sector one year is oftentimes the best sector the following year, right? So healthcare, has been one that's been beaten up a lot. You Trump and RFK Jr. Putting pharmaceutical companies on the across the grill, and so a lot of that I think has been priced in and digested. And so if you think of sectors or areas of the economy that are super inefficient and cost way more than they should. It's like, and would probably benefit a lot from AI. Healthcare is one that's right at the list. It's beaten up and could be a great beneficiary as well of the AI revolution.
A point to your small caps that you were talking about, smaller companies tend to perform better in a lower interest rate environment too, which we are supposedly going to be getting this year. So it could be another thing that, helps them push along.
Yep. Yep. Exactly. So it doesn't always work out like that. Like it's not, a guaranteed 1-to-1, like, oh, rates move down this equals X amount of performance. There's always so many other factors that can go into it. But yeah, there's a lot of interesting stuff brewing. And, I think the biggest companies will probably keep getting bigger, right? The most successful ones will keep rocking and rolling. But yeah, I think there's tons of opportunity for smaller businesses to make strides that they never thought were possible.
And I think when we talk about artificial intelligence, it really just leads it to technology and, the technology sector in general. Kind of the current sentiment is that it's all overpriced. We could be in a bubble of artificial intelligence. And right now it's, how much should I allocate towards technology? Does it make sense? Does it still have room to grow, or are we back in the dot-com bubble? And so I think technology is something that's very interesting going into 2026 when it did really well last year in 2025. So technology was a leading, asset class. A lot of talk right now is there a bubble, and how much should I put in my portfolio in 2026?
So Nick kind of previously had talked about things that we're monitoring and continue to monitor is the interest rates, what the Fed rhetoric is, and things moving forward. One of, I think, maybe the silent winners, not necessarily in terms of return, but a solid return. And when we have conversations with clients is cash, right? Or high yield savings accounts. When you look at 2025, because the interest rates were so high, high yield savings accounts were getting a higher return. So in terms of strategy, if you had any short term or allocated expenses for that year, a high yield savings account may make sense, right? If you think, pre 2022, when inflation was getting high, interest rates are low, banks didn't have that leverage to offer, a higher return or yield. And so average savings account might have gotten like 0.5%, maybe 1%. But as the Fed raised that interest rates, high yield savings accounts, banks had that leverage to offer. I've seen them as high as 5.5%. But now as the Fed's lowering that interest rate, we do see that those high yield savings accounts, they don't have the leverage to offer that 5.5%. So something, that may have won the past couple years was those savings accounts. Make sure that you're monitoring those as we get into 2026, but because you won't be getting those high returns. So that's when you kind of look at your strategy. Does it make sense to invest in some of these other asset classes?
I'll go on
Yeah,
the opposite end of the risk spectrum, and I'll go from talking cash to talking crypto.
Mm.
2025 was a year where a lot of regulations, a lot of talk was positive for crypto, yet we didn't really see Bitcoin or other cryptocurrencies do that well. So I think the crypto community is starting to find out that sentiment and regulations and financials are all kind of their own separate thing. And you need to factor all of those in when projecting, what the year may look like return wise.
Yeah, if crypto delivered anything, it was volatility, right? And that's the thing that you can count on in the Bitcoin space. So, had swings. It went from like 80,000 to 120,000 a coin. So, like percentage wise, that's a huge move for any asset class in a year, right? Going from, it's a whatever 30-40% move. And so, yeah, I think, having stuff that's volatile, and like we have some strategies that allocate to crypto, and a big piece of that is counting on it to be volatile. So even if we're just looking at, a very strict, January to December, different time frames look super differently over any of these things. So we as humans like our nice cookie cutter calendar, starts and ends, but the real world and the economy oftentimes move in a lot different cadence than that. So yes, like to your point, Tyler, like this was the huge, probably the biggest year for crypto ever, calendar year, but then calendar year wise, maybe wasn't the most exciting.
Yeah, and that's ultimately a good point because we also, as humans, Nick, fear of missing out is a real thing, right? FOMO especially in the finance world, works against us when it's going great and never seems to work for us. However, if you're talking international, whether it's commodities or crypto, I doubt we're going to be strongly talking about these at the start of 2027 because it's all going to change. We didn't know it was going to happen, and we don't time the market. So that's why it's always important is just to remember to talk to your advisor, make sure it coincides with your plan. Nora, you talked about the strategy and making small changes there. Every story is different, so making sure to talk to your advisor, make sure that regardless of what's going on in whatever sector in whatever year fits with what you got going on and marries up well with your overall financial strategy.
I think we've beat all those ones to death, guys. Let's transition here. Talk a little bit about the real estate market, what we're seeing there. I know some interesting changes have just came through in the last couple of days. So whoever wants to take that one, I teed it up for you.
Perfect. Yeah, I'd say so. What Ryan's referring to is Trump is allegedly going to push through some sort of legislature, executive order, something to limit Wall Street from buying up single family homes. And, how that gets implemented to be determined. What, if any of those Wall Street companies currently own single family homes, like we don't know if they have to sell those or unwind them. So there's a lot of question marks around that still. But real estate as a publicly traded asset class is up, 2.5% last year, REITs and stuff. So it could be really interesting on the Wall Street side. Maybe not the most exciting place to invest right now, given these new limitations. But to the average person who's actually trying to live in a house, maybe that's a great opportunity to scoop up something that's being forced to market.
and I think 2025 in general was just a change in the real estate market. In the Columbus, Ohio area, we saw, 2,000 homes on the market really for about 3 years, which is a very low number, even got below that. A normal market's between 6 and 8. And in about 3 months from February to May, we saw that number drop from 2,000 houses for sale up to 6,000. And the market went from being a seller's market to being a neutral market. And we've got clients in hot areas like Nashville and Florida and Austin, Texas, where homes were appreciating at crazy rates. And now they're underwater on their house because the real estate market changed in 2025. So 2025 was a very interesting year for residential real estate. And, allegedly interest rates are supposed to come down in 2026. The theory would be that that would help interest rates come down and maybe spur up the buying market. But certainly something to watch in 26 is does the trend continue to, or does it actually shift to a buyer's market moving into 2026, but a drastic change in 2025?
Yeah, I think the real estate market is just very much fragmented. City to city, like you said, state to state, Sean, very different. Even in Ohio, just from Columbus, much larger, growing city than Cincinnati, we're just steady, 3-4%, every year. We're not affected. We haven't been affected at all by, um, like you said, more homes available for sale or the influx or outflow of people moving. So I think it's very geographical. And one of the things I think is so interesting, and it's a behavioral or an emotional thing, is I feel like so many people are anchored to like a 2008 type event. And they're like, I'm not buying in until the next real estate crash. Well, if you look at real estate over the last 75 years, those 3 years are like one out of the 7 years that real estate prices ever went down across the US. But people like to just stick to that and think that they're going to get another shot at prices that low or some huge correction across the board. So, I always, when I talk with people about that, should I buy a home now? It's much more, yes, there's the math equation, but also the life equation to that. You're a growing family. Do you need more space? And so I think real estate is becoming much more nuanced than just, where interest rates at, what are home values at, what's the math. Um, so hopefully I see some of these regulations and changes are positives to some of those families, looking to get into homes.
And I would think if
Totally.
you're thinking you're going to buy a home or wait for the interest rates to drop back down to the 3%, or we had clients getting, houses at 2.5% back in 2022, realize that that is a anomaly that it did last from 2008 all the way through 2022, but that may never happen again, right? Homes normally appreciate in like the 4 to 5% range. Mortgage should probably be somewhere between 4 to 7%. And so we're kind of in a normal market. If we're waiting to buy a house until it drops back down, it may never happen. And so what we have changed kind of our advice on is how much money to put down towards a house. Those people that had 2.5% mortgages, if they won the Powerball last week at 1.7 billion, I would have told them not to pay off their house. And now, if you're buying a house at 7%, if you got cash, I'd put as much cash down as possible. So the game has changed, our hurdle rates changed, and if you're waiting for it to drop back down to 3%, you may be waiting another 80 years for that to happen. So not something I necessarily recommend.
Yeah, the other thing we haven't touched on yet is bond and fixed income, which is very important to a lot of our clients as we have a lot of retirees. Maybe we can talk through that a little bit if you want to kick us off for that conversation, Sean.
Yeah, so bonds was a wonderful year in 2025. They suffered their worst year ever in 2022. And we kept saying, hey, whenever interest rates drop, bonds are going to be a place to be. Well, we started to see interest rates drop, and we saw bonds getting anywhere between 6 to 8% return. So they had a wonderful year. They're in the portfolio to de-risk the portfolio, not necessarily to go look for an 8% return. We implement them to tailor the portfolio to a client's risk preference, but they end up being a pretty good winner. And so if we could get 8% out of bonds every year, we would take it. But a really good year in 2025. And then the question would be in 2026, if interest rates continue to come down, do we continue to see another, kind of banner year for fixed income bonds as well?
I think bonds are like the least sexy thing we talk about, but also the most interesting, no pun intended. And it's one of my favorite spots to shine a light on when, as Nora said earlier, like as cash rates come down, it's like people who are good savers and conservative, like risk wise people, they're ultimately going to get punished for staying in cash. Like it just gets less and less exciting as that rate comes down. So taking even baby steps up the risk curve, from cash into short duration bonds, normal bonds, can be very, very beneficial. And quite frankly, rates still have room to come lower. So, like, I would say you haven't missed the boat on bonds. Most of the bonds right now are going to be in the 4 to 5% return range, which is already higher than you're getting on the cash side. So, yeah, should be another good year for 26 for bonds. So probably not going to experience another 2022 scenario next year.
Great discussion, guys. This week, we're going to hand it to Sean as the winner. You can tell he's passionate about this stuff. So we're going to let him jump on his soapbox for 60 seconds. Sean, what do you got for your 30 to 60-second rant of the week?
Yeah, I think when we talk about asset classes and commodities, it's going to be hard to not mention oil. And in current day environment, we just had Venezuela, big news down there, getting over a deployment with the military, going to help building up what happened down there. I can say that, our questions are the same as yours. And that is, what is the long-term play of this? How does it impact the markets? I think there's a lot of uncertainty. No one really saw this coming. And what are the long-term implications? You like to hope that we do this and there's a plan in the back half, but I think everyone that's worked in the government long enough knows that oftentimes we take action and think about the long-term strategy later. So at this point, we're all hoping it all works out and that there is a long-term plan and this wasn't just a one-day operation that leads to more chaos. But certainly expect to see some influx in oil and oil prices, what happens both domestically and internationally. More to come, I think is all we can say with President Trump.
Thanks, Sean. Yeah, he likes to keep it interesting for us. So at least we've got that going on. Thanks for joining us for another week of Balance Your Wealth. And we enjoyed doing this for you guys and look forward to seeing you next week.